It's been a terrible few days for markets, with investors perhaps finally waking up to the fact that inflation is a bit more sticky than expected and rate cuts perhaps a bit less likely. So hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 16th of April 2024, and before I get started, you do need to be aware that whatever I say is general advice only, so you have to consider whether it's appropriate for you. So the big news items from last week and this week are the US CPI, or inflation reading, and the US retail sales. US CPI last week came in at 3.5%, which was, I think, broadly in line with the levels for February. It was March CPI numbers. Month on month, it grew at 0.4%, up from 0.3% growth in February. And overall, CPI is proving a lot stickier than expected. CPI is an analog for inflation. It's a measure of how much a basket of goods, how much the price goes up each year, and it seems to have started to perhaps re-accelerate after coming down for most of last year. We've had strong numbers in January, strong numbers in February, and now March looks to have been even stronger than February. And it's really not the trajectory that the Federal Reserve wants to see it heading. So for me, and I think we've been saying this for some time now, economic data still looks really strong. It still looks inflationary. It doesn't look like, these high interest rates are bringing inflation back under control, at least in the short term. I do want to just quickly touch on here my belief that for higher interest rates to reduce inflation, you do need to see an economic slowdown. Interest rates are a cost, and if costs go up, prices go up. For that not to happen, we need to see some economic damage to occur. We need to see, unfortunately, businesses collapse. We need to see debt defaulted on. Otherwise, I don't really think higher interest rates are necessarily deflationary. So, yeah, really that did spook markets a bit last week, that higher CPI reading. It did push out the rate cut expectations towards the second half of the year. And that was only sort of augmented overnight by the stronger than expected retail sales. Retail sales grew at 0.7% in March. That means that people spent, 0.7% more than they did the prior month. Really sort of not the ideal situation for a market that wants to see things slowing down. If people are spending that amount more each month, that's not going to lead to prices falling or prices slowing down. It's going to keep prices pushing higher. And so again, we saw, the market push out their rate cut expectations. And really that sort of starts to call into question whether we'll see any rate cuts at all this year. Now, I just want to say, I think there probably will be rate cuts this year, and I think, right at the end of the year is probably looking likely at the moment. Economic data can change very quickly, and, the economic situation can change very quickly, and once things do deteriorate, I think the cuts will come pretty rapidly. However, it doesn't mean that we can sort of say, we'll cut in a couple of months' time. We're going to ignore this data, we're going to ignore that data, we're going to ignore this data. The cuts are coming shortly. And I just wanted to say that I think Jerome Powell risks sort of being way too dovish at much the wrong time, as he was in 2021, 2022. You can't ignore the fact that, we've had some serious CPI readings, we've had some very strong US economic data, and yet he has ignored it for the last 3 months, and he's continued to say, no, the rate cuts are coming, it's just a blip, the rate cuts are coming. Well, it looks like the rate cuts aren't necessarily coming as much or as quickly as he initially said they would, and eventually, if the data doesn't deteriorate soon, they might not come at all. So I really think that he does have to change his tune, otherwise he risks looking even sillier, and I think he already is looking fairly silly. And the reason he's doing it is basically he wants to give markets confidence that, we know what's going on, we know what's happening, it's all going according to plan, we know you don't like the higher rates, don't worry, they'll be cut eventually. But the more you try and sort of maintain that narrative and try and look like you're in control, if things don't start turning to support your narrative, it's going to look like you're not in control, like you don't know what's going on. And it eventually could lead to a very severe crash like it did, in 2022, 2023, when they eventually did have to lift interest rates. So Jerome Powell will speak tonight. At each of the last few sort of speeches he's given, he's been very dovish, he's talked markets up, he's soothed markets, he's been essentially the biggest sort of bullish cheerleader for the market that it could possibly want. And tonight he's going to speak. We'll have to see if he changes his tune. Like I said, the longer he takes to change his tune, if things don't deteriorate from the data perspective, the worse it's going to be for markets in case he eventually does have to pivot. And that was the scenario in 2021, 2022. So it'll be interesting to see if he changes, how hawkish or dovish he is. I personally think he should become a bit more hawkish. But going on the recent trend, he's been very, very dovish. Regardless of what he says, I suspect we will see big movement after his speech. It could be up, it could be down. I wouldn't be surprised to see him talk the market back up a little bit. Finally, we are about to enter, or we are at the very start of a US company earnings reporting season. So we had the first cabs off the rank on Friday with many large bank and financial services companies. We saw JP Morgan, BlackRock, Citigroup, and almost all of them were actually down on their earnings results. Most of them beat expectations, but that's not enough to keep share prices pushing higher given how high share prices are. So most of them came down on Friday, but then overnight we had Goldman Sachs, we had a few others, and most of the reports overnight, the companies actually pushed a little bit higher. So it is a little bit of a mixed bag at the moment. It is expected to be a pretty good earnings season. Usually these are fairly positive times of year for the market, but it's too early to give a general trend for this earnings season. I do want to caution that expectations are high and prices are very high, and that can make it a little bit hard for it to be a positive time of year for the market, but stranger things have happened. Following the US earnings season, that's going to run for a couple of weeks. Following that, we will see some Australian bank reporting. That's going to kick off around the start of May. We've got ANZ, NAB, Westpac, Macquarie, and a few others that are going to report earnings, not CBA though. And it'll be interesting to see what that holds in store for those banks. Those banks are extremely expensive, and I would be a little cautious holding or trading those banks around that time. So let's have a look at the charts for this week, guys. This is the XJO, the top 200 stocks for the Australian market, and it has had a terrible 4 days. 4 days ago, we were at 78.50. We are now sitting just above 7,600, 250-point fall in a very short space of time. It does come after a very, very long uptrend, and it does come, with prices looking extremely expensive. But we've fallen back to a pretty key level, and we had a very large movement today. So we're on the 7,600 level. Wouldn't be surprised to see a bit of a bounce off this level. It is rare that we get more than 4 days of selling in a row. If we do bounce off this level, my first upside target is 7,700. And if we break below this level, there are levels roughly every 50 points that we might look to fall to. 7,550, 7,500. But overall, if we do see sustained selling, I would expect the next move to be towards 7,350. Looking at the US market, the S&P 500, it did fall back to its own support level at roughly 50-60 overnight, 50-50 let's say. That was a gap level, that was a previous high, and it acted as support throughout the latter parts of February. Should they break below that level, the next level is probably about 49.40. If they bounce from here, looking for a move towards 51.50. Like I said, expect to see movement on the back of Jerome Powell's speech tonight. We're waiting to see whether he remains as dovish as he has been, or whether he turns a little bit more hawkish in response to the recent data. Personally, I think he should be a bit more hawkish, because if he remains dovish and the data doesn't deteriorate to support his message, the eventual crash will be much more severe. So I will wrap it up there for this week, guys. Hopefully you enjoyed. Hopefully you've clicked like and subscribe already, but if you haven't, please do so now, and we'll see you in the next one.